BMO just confirmed what a lot of people really suspected, but few actually want to admit. Canada's housing bubble, it didn't pop. It's been deflating for 3 years, and their analysis suggests that we're only halfway through a correction that could take up to another 5 years. Here's the data that changes everything. BMO's capital markets economist Robert Kapchich just published an analysis that should make every real estate investor pause. And let's be honest, this is highly pessimistic. But he says Canadian home prices have been falling since early 2022. Big surprise. And the trajectory, he says, looks eerily similar to the U.S. housing crash of 2007. The data that was used was BMO's capital market reports comparing Canadian decline to U.S. 2007 crash trajectory. And this matters because it could be potentially a major bank itself declaring this is bubble correction, not a temporary dip. But here's what makes this different from the usual doom predictions. BMO isn't forecasting a crash. They're documenting one that's already 3+ years unfolding. Home prices have been declining since, as you know, February of 2022 on the peak, which means we're now over 3 years into the correction, 3.5 years to be honest with you, which means that this isn't speculation of a future collapse. This is an ongoing deflation, and it's not even in all markets in the country, some for sure. The data that's used supports that analysis. Ontario obviously being the worst offender. House prices are down 6.7% year over year as of September 25. And Toronto prices have fallen 27% off peak of February 2022. In 10 GTA neighborhoods, the single-family homes are down 40% for the peak. But let's be honest here. Toronto isn't the entire country, and Ontario isn't the entire country. So what they're experiencing in that province and in that city, it has its own bubble, although it's not sheltered from the rest of the country, is much more extreme than we're seeing in many other places in the country, really, at this point. But I will break down specifically BMO's analysis and compare it to historical housing corrections in Canada and the US and ask myself the question, why is the bank saying it's next to impossible to recreate the conditions that fueled this particular boom? But let's start off with BMO's argument, because honestly, it's important to understand why they're even calling this a bubble now versus during the run-up. The BMO economist Robert says bubbles are only recognized in hindsight after a market has already corrected. A bubble implies prices were excessively inflated, and without a correction, it's arguable that an asset class was simply undervalued. He continued to basically say that the defense once applied to Canadian real estate, but not anymore. In other words, the 3-year price decline proves prices were excessively inflated during that time. I think something we can all agree was true. But we have a chart that actually explains and tells the story. And if you're watching this on YouTube, you'll probably get a glimpse at this. If you're listening on the Spotify or podcast, just try and imagine it. BMO compared Canada's current price trajectory to Ontario's 1990s housing crash and the U.S. national crash starting in 2007. But this matters because it's a widely held consensus that those two episodes were not, quote unquote, like those two times weren't bubbles. So by tracking their price patterns, Canadian real estate honestly has been showing a lot of the similar tracks at this point right now. The 1990s, it took about 8 years from peak to recovery. 2007 was quicker. It was about 5 to 6 years. Canada's currently tracking kind of between those two scenarios. One thing when we get into the deeper analysis on this, when you're thinking about your home value or whether or not it makes sense to buy or do whatever, is that technology in general, believe it or not, has sped up the timeline of these cycles dramatically. So to say that it could take between 5 to 6 years and 8 years is possible, but it looks like not only are these events occurring quicker, but they're recovering faster as well. So that is the one thing that I think they missed out on this analysis. But let's look at the current information, because BMO's analysis, whenever it was published, it needs to be validated by September 2025 numbers. And right now, I'm just going to use Ontario because that's really honestly a lot of data coming from there. We could look at BC, we could look at different provinces. Ontario's benchmark home price in September 2025 was 787,500, which is down 6.7% from a year ago. Benchmark, obviously different from average. In Toronto, which is the hardest hit of all the cities in the country, so we're looking at the one that has hit the hardest, average home prices of 1.225 in September were down 7% year over year and 27% off peak. But where it actually kind of gets pretty interesting is this analysis that found that 10 of these neighborhoods where single family home prices fell 40% off peak, which is wild. Again, I want to be hyper clear. This is worse in Toronto than any other province or city in Canada, but that's why we're using this as an example. The detached homes in the Greater Toronto area averaged 1.359 million in September, which is down 4.5% year over year, with anything that's like a row home or something like that seeing an even bigger dip. But let's move on. This is happening really because, and BMO makes this point, not Alex, that record population growth began between 2022 and peaked in 2023. So despite peak population, we're seeing the dip in values. And think about that. Prices are falling 20 to 40% in many markets while Canada's experienced the highest immigration in history. That's not a temporary affordability issue. That's a fundamental repricing of real estate. And this matters because if you think about the simultaneous record immigration and the price declines, it indicates a structural correction in property values. Now, digging into BMO's historical comparisons, because I think understanding the past housing corrections help us understand where we're actually going in the future, at least to a degree, like I mentioned. In the 90s, prices peaked around 89 and then declined thoroughly through the 90s and didn't recover, honestly, until like 97, 98, which was about 8 years peak to peak. And when I say recovery, it's like from the high point, dip down, back to the high point. How long did it take to get to that point? About 8 years. In the 90s, it was because of excessive speculation. In the late 80s, rapid rate increases to fight inflation, recession, and oversupply. Particularly, this might not sound surprising to anyone, in the condo market. During that specific correction, because we're looking at Toronto here, their prices fell 25 to 30% from peak to trough before actually stabilizing and recovering. In the US, which everybody references the US, this is the US, not in Canada, the 2007 to 2012 housing crash, national home prices peaked in mid 2006 to early 2007, and they bottomed around 2012 and recovered at like 2012, 2013, depending on the market. That's about 5 to 6 years, depending on the market that you're in. Again, this didn't happen in every market, but a lot of markets. The US crash was basically subprime lending crisis, which was rapid credit tightening, foreclosures, and ultimately a massive correction that actually helped to restore affordability in the US markets in many cases. The big difference is that the US correction was 25 to 35% nationally, with some markets like Phoenix, Las Vegas, and Miami down 50% from the peak. And Canada's correction is way less severe, way less severe. We've got the extreme cases like Toronto and in some areas of Vancouver, but in most other provinces, they're not seeing these levels. But it's much more drawn out so far in Canada. So slower, but more sustained. The bank's analysis suggests that if Canada continues tracking the US path, we're looking at another 5 years to recovery from today. If we follow Ontario's 90s trajectory, it could be 8 years from 2022, meaning 2030, before they actually see 2022 price points again, which honestly, for an extreme situation, could be possible because we're already entering 26. Wouldn't be shocking to see that. But there's a lot of thought process from people that this time will be different. BMO says that's not the case. Remember, they're referencing the worst case scenario here. They're not referencing all cities and all provinces. There have been some cities that have actually seen increases since 22. Look at Alberta, Calgary, Edmonton. Look at eastern provinces like Halifax. They've seen increases since 2022. But they say that systematically they can explain why the conditions that created the boom, it can't be recreated. So, for example, this economist lists that the perfect storm that created the peak millennial demand, record immigration, pandemic migration, crazy low rates, maxed out valuations with people refinancing, pulling out equity, and honestly, just that whole like speculative market psychology. People looking at the market and saying, I can speculate on this and buy on this. But to understand why BMO says it's impossible to repeat these conditions and see this actually again. Let's break it down. So peak millennial demand, the largest generation of home buying, they hit their home buying age, which is 30 to 40 years old, right during the pandemic. And that demographic wave, it's kind of now past peak home buying, even though there's still a lot of millennials to buy. And they won't repeat for another generation. The record immigration, while Canada maintains crazy immigration, the record levels of 22 and 23 are being scaled back massively. And the federal government's significant immigration target reductions for 25 and 27. With pandemic migration, the shift from urban, everybody's moving out of the city to suburban, from expensive to affordable markets, was unique. And honestly, not something that we're going to see probably anytime again, even though it has changed how people live and geographically how cities are being built. There's city return to office mandates. The trend is like going backwards at this point right now, and that is causing reduced valuations in a lot of these cities. And then when you think about it from an excess liquidity perspective and ultra low rates, basically the government was funding CERB, giving money to people that went right into housing. These crazy low rates, 1.5% to 2.5% that are coming up for renewal right now. Even with the rate cuts right now, the BOC going the overnight rate to 2.5%, we're nowhere near, and we're not likely to actually get down to that 0.25% rate. We got 2.25% to go to get down to the rates that we were, which is a significant difference in total cost, right? Plus, on top of that, there were crazy valuations even after the current correction. Home price to income ratios were out of this world, and people could qualify because the rates were exceptionally low. There was speculation. People were speculating on everything. Buy a pre-sale, wait for it to close, cash in. Buy it, wait, cash in. And now after 3+ years of declining prices, the psychology is actually reversing, and it's actually going backwards for people, where it's like the fear of catching a falling knife. So people are doing the exact opposite of speculation. They're avoiding it completely altogether. Basically, the bank is saying it's going to be impossible to repeat these conditions. And because of that, the bear market in housing staggers on. It'll continue. This market continues on until affordability and or investment dynamics reset themselves. And that is what the market is saying. So what does this mean for you? I think at the end of the day, it's like, what the frick does this mean for you? If you're an investor, you're a homeowner, you're a first-time buyer, what does this BMO analysis actually break down? For real estate investors who bought in 2020 to 2022, honestly, you're likely underwater or barely breaking even if you purchase at the peak right now. For example, if you bought like that Toronto or Vancouver house for 1.8 million in February 2022, it's probably worth 1.3 to 1.4 today, which is like a 27% decline, a 400 to 500 grand on paper. Their timeline for recovery is 5 to 8 years, which means you're looking at 2027 at best case to 2030 before you see those 2022 prices come back. And if you factor in carrying costs over that period, the investment can get really challenging, and we're going to see that play itself out in the marketplace. For people who bought pre-2020, they're probably significantly above their purchase price, even with a correction. A lot of people don't realize this. There was like a 2-year timeline. If you bought in March 2020 versus buying in March 2022, that was a dramatic difference, and you're probably way above it. So you still have a significant amount of equity, and you've probably grown, and you're probably in a net positive situation. If you bought in 2018 at 800 grand, that home was probably worth 1.1, 1.2, and you still gained a significant amount of equity. So that does not threaten your position. Unfortunately, the people that are hurt the most are those who bought in end of 21 to I guess the middle of 2022. Those are the ones that have been hurt from a financial position perspective. But for first-time home buyers waiting on the sidelines, BMO's analysis basically suggested that your patience and or continued patience could be rewarded with one caveat, and they specifically said there is value in home ownership for the person who is able to hold on to a property. And in specific in this report, it also mentions what I said to you before, which is that you have to understand not only your personal and financial situation, but the city and the location that you're actually purchasing. If you're looking at a city like Toronto or one of these areas, and you're looking at a condo in these types of downtown cores, then there is value because prices could stagnate for up to the next 3 years, according to BMO. But again, they clarified really specifically that although there is no urgency, it can take 5 to 8 years, which means that we could be looking at 26 or 27 when the housing quote unquote correction flatlines or starts to work back up. There is value in home ownership, and they're just basically being cautious for where and when that person is buying real estate. The feedback is clear from BMO's report. They're suggesting that anyone purchasing real estate should be prepared to hold that property for 5 to 8 years. in any best or worst case scenario, which matches truthfully what you should be willing to do anyways. For sellers who need to move, BMO's analysis is pretty sobering, and this isn't surprising. If you're selling in a market 20% off peak, you're realizing it's not beneficial unless you bought your home pre-March 2020. Like, don't do it. That's what they're saying in the report. And the insight from this report is basically that markets don't recover quickly from bubbles. Like the 90s took 8 years. The US correction took 5 to 6 years. Quick recoveries don't typically happen, although there could be a situation where this happens. Now, the BMO forecast, as I mentioned already, like if you're in BC, you don't really care about this, but it relied heavily on Ontario because Ontario led the boom and is leading the bust. That's why I keep putting the caveat in there. Like if you are from a different province or a city, that you should be paying attention to this, but you shouldn't use this as the gospel because they're getting the worst of it. They represent, but we got to understand why they did this. It represents 40% of Canada's GDP. Toronto is the largest real estate market in the country. And when Ontario's market corrects, then it has national implications across their shockwaves, even though it's not the worst. What's interesting to note is that while Ontario is down 6.7%, BC is only down 3.1%, although it's significant, nowhere near as bad. And the national is down 3.4%. So remember, not all cities and provinces are the same. Like I mentioned, Halifax, crazy. Halifax is actually up right now. And it's important to understand this, the fact that it is contradicting regional markets and are different. And when the largest market in the country is correcting, their feedback is that you need to be aware, however, that it eventually pulls down other markets through migration, interprovincial arbitrage, investor relocation, while acknowledging and them being aware that we've seen the most interprovincial migration ever, specifically from Ontario, from BC into places like Alberta and like New Brunswick, Halifax, these different areas. There is going to be eventually a impact from this marketplace, at least according to the BMO report. Now, we'll see how this plays out. I mean, the markets that held up really good in 2023 are now showing a little bit of weakness in 24, 25. Edmonton was in multiples all of 23 and 24. This year, we're seeing that really slow down and come back down to earth. And whether or not that's a flat line or that's a dip is hard to say. But the truth is, while capital markets are like this report, what it's actually saying is that Canada's housing bubble isn't going to pop. It already has. So for those who are like, we're in a bubble, they're saying we were already in the bubble. We're 3 years into a multi-year correction right now. So the truth is the data itself, like it supports the analysis. And again, this is nothing new. We've been talking about this for the better part of a couple of years, but I think with this kind of data coming out, it's a good reminder of the fact that we're not waiting for the bubble. We are in the bubble. We're in it right now. BMO compared the trajectory, as we mentioned, the 90s, 2007, taking 5 to 8 years off peak. So if we look at the math, then 2027 to 2030 is when the market continues to jump back up. Now, of course, if we do follow the US's sharper path, we're looking at a recovery around 2027. If we follow the 90s of Ontario, we're probably waiting until 2030. Either way, the property values will recover. And for the most people, the big question is like, well, when do I get back in? What do I do? The biggest thing that to note here is that BMO's most important point is that the conditions that created the boom, which was like millennial demand, record immigration, pandemic migration, ultra low rates, lots of liquidity, psychology of speculation, that stuff it's very difficult, near impossible to recreate that. So the chances of that happening again are pretty low. Again, if you're an investor and you bought at the peak, the feedback is really simple. Hold on to your property as much as you can. Patience is everything. And the same for first-time home buyers is patience, but be aware of the market dynamics. The one thing that everyone should be aware of is that these bubbles don't recover quickly. They tend to kind of like go down, dip up, dip down, and then there's like a stability before it works back up. I would say the best thing about all of this from a buyer perspective is that truthfully, what it has created is a market of choice and opportunities. I've talked to people, myself included. I bought in 2024, and even though my property value might not come back or increase until 28 to 2030, I genuinely don't care. My intention isn't to sell this property tomorrow and get back in the marketplace. But what we will see most likely for most people who are still looking to get into the marketplace is, or what I would recommend for you is make your decisions based on fundamentals like income, your employment, stability, your long-term housing needs. Like, don't wait and buy because you want to see the housing prices come back up to 2022 markets really quickly. That return, again, 5 to 8 years off peak means you could be sitting there for a long time. Now, if you found this information helpful and you want to find out what this means as far as your mortgage is concerned, Make sure to stay tuned while I'll break down more about the Canadian markets and how this is going to impact the Bank of Canada's decisions in the coming weeks and months, particularly in light of some big news that just came down the pipe. Thanks again for watching. Subscribe, hit like. We'll see you on the next one.